All right, we are back after a week break. So, but today it's just myself, Chris, and we got Stuart. Rick is tied up with tackling very important things as usual. So, it's
As usual.
you can't let something pops up that's got to be dealt with. You either have to let it go and deal with it later, or you just deal with it then. And we all
Yep.
we all know Rick's personality is I'm dealing with it right
Immediate.
now.
Immediate.
So
Yeah. No
it's
time for potting.
yeah, it's like critical path mentality always, which
Yeah.
uh
It's
which is
good.
good.
It's good
That's a good
mentality.
um well, more importantly, guess what has happened in the last week?
What has happened?
Well, Ferrari is no longer number three in the constructors standings. They are in second place
I saw
because
that.
Carlos killed it at Mexico. Leclerc did pretty good too, but
They both had good races, but yeah, Carlos, I mean, this guy is just how long's he been around now? Still just doing like amazing things on the track.
he's had a good year. Let me see where I didn't look at the driver standing results to see. I know,
I'm saying in terms of like
yeah. So
longevity
he's
for a driver, there's only a handful of guys who are really like at that level for that long. I feel like he's been around for a long time.
but Carlos. No, Carlos. I think he's only really started to kind of pop in the last couple of years. He's been around, right? But he's as
Yeah.
far as kind of peaking consistently is just with his stint at Ferrari, which right now, I mean, right now he's in I guess number five in standings. Um, and so I mean, he stands a pretty good chance. He can may he might be able to get fourth. Let's see what the rest of the year goes, but he'll probably end up at five, which is still pretty good. I think we'll see what Williams does. I have no idea what their car is, but I know he's going there next year. So um, I'm really more interested to see Lewis, what happens when he goes from Mercedes to Ferrari. And we have this Lewis Hamilton and Leclerc kind of battle of who's going to be the prime driver for Ferrari.
Yeah, I feel like
I don't
Mercedes
know how you
car
don't
hasn't.
automatically give it to the guy who's the best driver in history. So it's like,
Yeah, well, that's the thing. Like, I mean, best driver in history for sure. It's hard to debate that, but like, he's clearly not been in a great car for the last few years. So I think he's struggled a little bit because of that. So
well,
it's
I
gonna
think
be interesting to see like when he gets back in a car that's I mean Ferrari's really stepped their car up as of late to see like does he pick right back up where he left off?
well, is it the guy? Is it the man or is it the car? Right?
That's
And
the
it's
point
like,
I'm getting at, right? You're gonna
yeah,
find out really quick
yeah.
because I mean he was doing great when Mercedes had arguably like a car that couldn't be beaten, and so you couldn't tell. I mean, obviously he's got a ton of talent, but it's like how much of that is the car, how much of that is the man. Then all of a sudden, some of the other cars catch up. The Red Bull car was hot with Max in it, and you haven't heard much from Lewis, since then. I mean, obviously he's been around the top, but not the way he was prior to Red Bull's resurgence. And now you've got Ferrari, who's gotten their car straight finally. And here comes Lewis. He's going to be sitting in one pretty soon. So my question is like, when you get him back in a top car, are you going to see him at the front of the pole again? I think that will tell us a lot.
Oh man, I'm just looking at the schedule. Las Vegas. It's November 21st through 23rd. I'm
Mm,
gonna be
you
in
can get there.
Phoenix.
Aren't you
I
going to be
know.
in Phoenix? Yeah,
I know.
yeah.
I'm like, crap. Do I play hooky on what I'm supposed to be doing in Phoenix and
Might
go
take a
to
little
Las Vegas?
detour. Might take a little detour.
Yeah. I
Does Rick like
may.
F1? Isn't he going to be there with you, Phoenix?
He'll be home by then. I'm staying
Oh.
for the weekend, and I'm gonna have to look into that. I'm gonna have to look into that one. So I think we're going to talk about this topic. This topic I'm about to discuss. We're going to start off very basic and dumb, right? Because
My
there's so
favorite
many
way to
different,
start.
yeah, there's so many different ways this can go. And we're going to probably have several episodes about this, but it's going to be around the, let's, let's call it the investment, might be a good way, like just the investment portion of the timeline.
Yeah.
Again, we're going back to this like timeline of development. It's like, well, um, I get that we could, we got a site, we got design, we got construction, we got all these different things, but like, how do you, you know, go beyond just the instinctual thought of that I can make money at this deal to let me quickly see if I can make money at this deal with a dumb kind of back of the napkin. And then that usually moves on to we've learned a little bit more about a deal. We can inform the formula a little better. And then to now we know a lot about the deal. We got to revisit we call it a pro forma, right? Um, it's kind of like maybe the technical term of evaluating the investment. And then you start to learn about, who's in the deal with you, and is it debt, is it equity, you have both, do you have how many partners on it? And it starts to really complicate the investment modeling, analytical work around, the pro forma, the money side of a deal. Um, in one aspect, it's very simple. And then the other aspect, it's incredibly complicated, right?
Yeah.
Just like design, right? In design, it's in one aspect or one thought, you're thinking, I need a building. I can just draw a box, right? It fits on a pad and it has a parking lot. Anybody can sketch that. As dumb of a sketch as it can be. I look at it, a building could go there. Um, but coming from the design world, it's like, okay, that's great, but then what kind of building? What's it made of? What's the envelope? How many rooms? What's the material? What's the finishes? It's what kind of equipment? So that you start to like really build on, I guess, the layers of intricate detail that then cohesively speak to their overall product, right? Um, the money stuff is very similar. It's just instead of a tangible thing that you see that will be built, it's just math, right? It's just variations of the same expanded math equation. Um, so I think we're not going to cover nearly all of it today. We'll kind of do
No, but
some.
I mean, you've kind of put together what I would consider to be like a pretty good check for that first step, right? You've got a little spreadsheet that you've kind of built over the last, I don't know. Well, you've built
Well,
it
we got
recently,
several.
but the materials come together over a long time, right?
Well, there's several different versions. I mean, I have a folder of Performa templates, right?
Right, well, that's what I mean. So
And
like
so,
the knowledge base itself has been around or with you for a long time, but you've recently sort of taken that and designed a sheet that I think will be very helpful to us in evaluating deals very quickly at
yeah.
the onset of the deal and the conceptualization of how the financing comes together. So the knowledge has been around a while. You've used it in various different ways, but of late, you've
Well, what I'll
taken
do
that
is
knowledge out and created this spreadsheet. I think that the the creation of that spreadsheet has sort of become the impetus for today's topic, right? It's got us as of late thinking a lot about and talking a lot about this idea of the early check on the financing side. And I think that's where we arrived at today's
but yeah,
uh,
and look, I know we have a little statement on our entry page, but I will just say it here. Not financial
now would
advice.
be a good time to stop. and
Not
qualify.
financial advice. This is pure entertainment. No legal advice. Do not, in fact, don't do what we're saying at all. How about that? Just,
Yeah. Let's just be very
yeah,
clear.
we're going to
Do
say a
not
bunch
do
of
this.
ignorant stuff. Don't do this.
Don't
So,
don't
um,
take any of this as advice.
so, all right. With that said, I think we're good. The, and I may not even show this spreadsheet on this episode, right?
Yeah,
Because
maybe we don't. Maybe we just
I,
talk about the concepts
well, I
and
want
how that
to,
came together.
yeah, because I want to, let's talk about the philosophy, right? Because what somebody thinks a developer, a lot of people don't really know that there's different kinds of developers and there's different kinds of
Mhm.
real estate investors. You may know somebody out there, well, I guess a listener, if we have listeners, that's like they I have a friend who owns a bunch of real estate, right? They're a developer. Well, not really. It depends, right? So in my book, a developer is what makes them different is that the developer is they're seeing an opportunity in the real estate industry, right? They're finding property, building a lot or something that's exists, right? And a developer is going to say, I can take that thing, I can buy it, I can buy that piece of property, and I can apply my money, my time, my skill, effort, relationships with different professionals, um, and I can add value to the thing that I bought to increase its future value, right? So you're developing something new and you're building upon something that exists or doesn't exist to create something. So I look at a developer as like, in a way, a creative, just like somebody would make a podcast or paint a picture, or a painting, or what you're creating. Like it's a creative kind of character is usually a developer, right? And you see a problem. It's almost like an entrepreneurial, right? You see a problem in a market where a service is lacking in total or not being serviced appropriately. So it's like, I'm going to start a business. I'm going to fill a need. I'm going to create value in this business. A developer has the same entrepreneurial mindset, the creative mindset to say, there's a need for something here, or I could take this thing that has less value and add all these things to make it more valuable. And so it's kind of like you have this creator characteristic within that person, right? That's the developer to me.
Yep.
Um, then you have, a real estate investor, right? That's a very different type of person, right? And so a real estate investor is saying, I don't want to create anything. I'm looking for an opportunity to place money into something that then will generate cash flow return on that money I move. You're playing a money game. So it's more like a stockbroker
Hmm.
than like a creative mindset. So like, which, with stocks, you're buying equities, you're buying bonds, a lot of different stuff. So you're looking to just put something of value into another thing of value to create perpetual value, right? So it's
Yeah. And
you're
a
not.
lot of people look at real estate as a way to diversify
That's
other
right.
parts of their portfolio.
That's right. So I'm making this distinction on purpose because um, it depends on what kind of work you want to get involved in. Now, we kind of do it all. So we're both real estate investors and developers, predominantly developers, right? Because we like to create things.
Well, I think that's
Um,
where if we're not clear like you're being or trying to be right now, like people could get confused, right? Because
yeah.
we kind of blur the lines a little bit because we do both.
Yeah. So on if I'm a real estate investor, I might say I made money in something, right? My other business or inherited it or sold some stocks, sold another piece of real estate, and I want to go find, a real estate existing building to buy or invest in just to put that money. Like I'm going to go buy this shopping center. I can buy it. And usually what you look for is, what I guess what I look for is there's so many different acronyms of different ways to measure the success of a real estate investment. but is usually cap rate, right? So like say you had $1 million and you want to put the $1 million to work to make money, right? Have your money make money. One of the easiest things you could do is just go buy a CD. You go to a bank, you say, what's your CD? You have a year CD, the CD is going to pay you. What's the cap rate of that, right? The bank's going to say, oh, I can get you um, a 5.5 cap on a CD for a year. Pretty safe. You just basically lock your money up for a year and you're going to make 5.5% on that. There's a whole different slew of products in the financial world that you can do that with, right? CDs, money market funds, mutual funds, bonds. You can buy equities themselves, like Tesla stock, right? It's in stocks with dividends that pay a percentage. So you're looking for, what is the cap rate, the capitalization rate that you're going to basically expect a return on that invested money. You're looking for what is the margin profit. Um, so you look at real estate in a very similar light, right? Especially if you're a real estate investor, you're looking at, and because what happens is that margin, that return is going to be pretty instant, right? If you go buy a building that has a tenant in it, that tenant is paying rent. The guy who owned the building before you he probably is in it, a total investment less than what you're going to be buying it for. So his return on investment is going to be higher than what your return on investment is. But even at that, the return on investment could be still attractive to you because one, you want to just own the building and have a physical asset somewhere because there is that long-term equity gain, right? And owning the building that is separate gain compared to like your just cash flow return that tenant is going to be paying you. I think in today's world and for a long time, kind of like the 8% cap rate in real estate was kind of like the standard, right? Like, yeah, I want to make 8%, make 8%, make 8%.
Well,
Um,
you could expect to see that from that type of investment, right?
yeah, it's just like, look, I'm not gonna look at anything less than 8%. Now,
Yeah.
when the interest rates were super low, obviously, the expected cap rate lowered as well. So you had some people saying like, I mean, I saw people buying apartments at like 3.5, 4 cap, right? The um, so the expected return was much less. And the reason for that is because the cost of borrowing money to get the asset was also a lot less. So you kind of have like this relationship between the cost of capital to get money to buy something and your expected return on that money that you bought the thing at. And so, you know, what we would say is what's the spread between the two, right? So if you borrowed money at a 3 cap and you bought something that a 5 cap, well, then you're making 2% spread between your borrowed money and the the asset value cap rate.
Mhm.
So yeah, if you did it with all debt, well then okay, well then you're making 2% on a bunch of money that's not even your money. So it's pretty good, right?
Yeah.
Um, Now, if you paid cash for something and all you're making is 2%, I would call you not so smart, right? It's like you would if you're paying all cash for
You
something,
well,
you
you
want to
probably just have better options.
yeah. You're gonna want to make more, right? Because then it's your
Still, I mean,
money.
you're still making money. You just probably had better options.
Yeah. Um, so it's so on a real estate investor, and it's important to understand the investor because developers utilize real estate investors, right? They could be investors themselves, but they also partner with investors um, to do real estate deals. Because a
Mhm.
real estate investor is going to say, I'm going to buy an existing building and make money on the rent, right? And you're gambling on that the tenant's going to stay there, renew, increase rent over time, increasing your overall spread, which is going to gain you more margin of profit in the long run. And then on
Yep.
top of that, you've got the equitable, you know, rise in the real estate building and property itself. So you have like your cash flow of rent that increases, and then you have the asset value increase as well, right? In
Well, and you
terms
said something key there too, which is that the tenant will stay there, right?
yeah.
So critical part of that, or a lot of times what I would call, I guess, some insurance there is that you've got a lease, right, that's signed that has some sort of stipulation for how long the tenant will be in place, sort of guaranteeing in a way, or effectively guaranteeing that the investment is a safe one to make for a certain period of time.
Yeah. So you see people, um, you really need to care about the credit worthiness and
Yep.
the future safety of a business that is in a building that you own. So
Hmm.
um, you would think pharmacies, for example, were a safe bet for a long time, and they were. And they would buy the best corners, right? They'd spend the most money. The rents would be super high because of all the capital required to put up a pharmacy and buy that piece of dirt. And they've been there for a long time. As a real estate investor, you can go buy that CVS thinking it's always going to be a CVS or a Rite Aid, right? It's been there for 30 years. Of course, it's going to be
Hmm.
there. You buy it, and it's a, and but before you buy it, you look at the lease. It's like, oh, they got 3 years left on their 5 year extension, and then it's time to renew. I'm going to renew them at, and look, man, they're super low rate. I can increase their rate like 100%. I'm going to make all this money, and then you buy it, and then all of a sudden CVS is like, well, we're not going to have brick and mortar stores anymore.
Yeah, or maybe you squeezed them too much on that increase in rent,
Yeah.
right? To a
So
point that's beyond their tolerance.
so you can find yourself sometimes like the big juicy opportunity is devastating because now you've spent a bunch of money buying a thing that you can't really use for anything else. Um, the repurpose, and that's a whole other topic. It's like repurposing, building typology. But you also have people who are like, I own a kind of a middle ground retail strip center, and it's got a grocery store, and it's got a hair salon, a nail salon, and those things, they don't necessarily seem super sexy as terms of asset and tenant, but it's been there for 50 years and it's going to be there for another 50 years, right? And so it's just kind of, it's like hitting your it's like base hitting, right? You're just getting a base hit every year on a real estate
Yeah,
investment. It's not going to make your portfolio look incredibly impressive, but you'll have money in the bank, and this stuff you don't have to worry about it too much.
yeah. And look, the base hits, I mean, you and I have talked about this 1,000 times. Like you stack enough good base hits on top of each other, you're gonna score some big
Yeah,
runs,
you're gonna win the
put some
game.
numbers on the board. That's right.
So I think in order to let's stick to the real estate investment side because it's a component of the development side.
Yep.
The Let's say we are looking at a building. I want to do some quick math here. Just kind of, and again, when you do this enough times, like kind of the dummy back of the napkin math, because you'll see these guys do this all the time. They're looking at a real estate deal and like, all right, I'm gonna just quickly type in my calculator, and they somehow know what the deal's going to be, right? But that's a
Yeah.
ton of experience dumbed down into a very educated guesstimate of how the whole deal works. So if I pay $1 million for something and I want to figure out, I want to make an 8% return on that investment. So obviously that's $80,000 a year, right? So 1 million times 8%, 80,000 a year divided by 12, 6,600 a month that somebody has to pay in rent.
Hmm.
Um, when you think about buying something, is that a reasonable rate of return? That's if there's no tenant in there. So then, like, say you buy a building, it's like I gotta go find a tenant. And I want to make 8%. Well, what can pay me $80,000 a year, right? So I would say it's kind of a safe guesstimate again that at 80,000 a year, like I always try to figure out that in a business's allocation of operational expense, the percentage associated with real estate rent probably needs to be anywhere between 6 and 10%, right? So let's say it's 7.5%, right? So if they're paying 80,000 a year and they need to allocate 7.5% of their revenue, right, to pay rent, that would be a business that makes almost $1.1 million a year. So let's say I own a building and it's a pet grooming business, right, that needs to go in there. And I'm talking to, the business itself. Yeah, oh, we like your building. We want to rent your building. And what's the rent? Blah, 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 blah. Obviously, as the owner of the building, you're going to want to try to get as much as you can, but you also don't want to completely burden the tenant with paying you so much rent that they can't be successful in their own business either. Right. So, it's like, oh, I'm going to get, $180,000 out of these guys. They're dumb. They're going to pay it. Well, guess what? You might get that for the first year, and then they're going to go out of business, and then they're going to have to move out. They're on a rent. They got personal guarantee. Well, good luck getting all that and dealing with all that if they just went out of business. Like it just doesn't.
Yeah.
Just because you have it on paper and these things in the contract doesn't necessarily mean that like you're guaranteed to get all those things. And so,
Right.
a good real estate investor, they're going to look in and say, how can it needs, both parties need to win, right? It's like, as the real estate owner, it's like, I want to make money. I want to make a fair return on the investment. I want a tenant that's going to be respectful of the building. I want to make sure that they have good business sense. I want to make sure that I don't overburden them with rent, that they can be successful themselves. Because it's really a partnership at that point, and you want them to be successful and stay in your building a long time. And then you can again in communication with them say, obviously you can't pay the same rent every year for the next 30 years. We're going to have escalations, and we're going to grow what you pay me as your business grows and becomes successful as well. So we can both benefit, you know, by investing in this place and in your business.
Yep.
Um, so a lot of those things are really important to kind of always have in your head, like when you're negotiating like a rent with somebody. Um, that same mentality and thought process also goes into developing something for somebody, right? So we mostly develop new things, right? So we're buying property and then either building a facility for somebody to operate within and pay rent on, or we are buying a property, preparing it for them to lease the property, and then they build their own building. Now there's other investment reasonings for that, right? That tenant may want to do that because it's a different cost of capital that they can access to build a building versus borrow our capital, right? So it starts to kind of compound the complexity a little bit. But let's assume that we are doing a build to suit for a tenant, buying a land and building a building for them. And so, you know, the conversation needs to happen and this is where it's kind of tricky because the tenant or the operator is obviously going to want to pay as little as they can. So it's almost like buying anything, like a car, or house. It's like when you're negotiating back and forth, trying to figure out where the happy middle is. And what you'll find is like you kind of, as we do this over and over again for different people, is like you build trust and you have open communication with different brands and tenants. You really learn to kind of just stop doing that, right? And you basically go straight to the point and say, look, this is a great location. Like, what are your projections of sales? Oh,
Yeah.
you can do $2 million a year. All right, so that puts you at, you know, let's say it's again 7.5% of 2 million is um, roughly $150,000 a year in rent. Okay, great. Again, you're getting straight to the point of like, how do you win? How do I win? I know I've got $150,000 a year to work with. I
Yeah,
want to
how do you get
be,
this deal in this great location
yeah,
for a price that works for you, but also works for us, right?
that's right.
Hopefully.
So at 150,000 a year, let's say my target is I want to be completely in on the investment, total dollars, knowing I have $150,000 a year rent coming, and I want to be able to make 8.5%. So 150 divided by 8.5%, 1.765. So $1,765,000. So now I know I can't spend more than 1.765. Now, on a build to suit, the reality is that they're probably going to be paying more like 10%, not 7.5. So let's kind of rework this math a little bit. So let's say they do 2 million a year in sales, and let's do easy math. So we got 10%. So now it's 200,000 a year. Because now they're paying, not only are they paying the money to rent the land, they're also paying money to rent the
The cost,
facility, the building,
yeah,
the
the cost of the
improvements.
building. Yeah.
So it's a little bit higher percentage rate on their revenue. So 200,000, same 8.5%. So divided by 8.5, 2 point, just basically $2.4 million. Let's just round up so it's still easy math. 2.5. So I've got $2.5 million to spend total. That is buying property, demoing a building, building a new building, paying real estate fees, brokerage fees, that kind of stuff. Which, if you're renting or leasing existing space, you got to pay that real estate commission. So you always want to fold that in too, is what your costs are. But we'll leave all that for now. Um, so you got that sets your budget. So when people, if you say you're starting off on this new, and you're like, man, how do I even know how to set a budget? Well, you kind of do the reverse engineering method of like, what do we think this business that's going to be renting from me will make? And then have it fall within, again, 6 to 10% of what their revenue is based on what they're renting. But if it's a full build to suit, it's going to be more on the higher end. So say 10%, then that's going to give you that rent for the year. And if you want to make 8.5% on your investment, then you divide that rent by that 8.5%. That sets your budget, right?
Yep.
So you don't necessarily have to think
Point.
about, making up all these numbers to get to a number, right? I think I see a lot of people try to like build it from the bottom up to
No, I think
start.
the point you're trying to make, right, is the age old adage of know thy audience, which is basically what you're saying is you have to know a little bit about who your tenant is going to be and what their annual appetite for rent is, right? And it's projected off of their
Yeah.
revenue. So you got to do a little research on who it is you're going after and understand them well enough to be able to put together a viable deal, right? You got
Yeah.
to understand how they make money and what type of money they make every year. What does that look like?
No, that's right. And the thing is, and if you don't know that and say somebody's not willing to tell you that, that's really where a broker would come in, like a real estate
Yeah.
broker. They should know. I mean, I think if you're a real estate broker who is like, I don't know. I mean, we're just gonna throw a number out that I'd get a different broker. So it's like, I mean, somebody, especially in the commercial space, like a good
Yeah.
commercial real estate broker is gonna have done the research. They're gonna know. Like, I'm not a broker. I look at what things trade for on the open market all the time for real estate leases and things. And so like I know what different brands and different uses will be able to trade at on a cap rate to know this is kind of what the deal needs to be, or this is, what the rent needs to be to make it work. And also the
Yeah, look.
location is going to change a lot too. So like if you're obviously in a big metropolitan area, that's a different kind of revenue projection than like a rural area. So
Yeah, and look, to get into one of our other, topics of discussion previously, it's like we're in the age of information, right? It doesn't take a whole lot, even if your broker. To your point, if your broker doesn't know, find a new broker. But um, I mean, I think you could probably figure out, you know, annual revenues for most anybody by doing just a little bit of research online or asking a good friend like GPT, um, you know, asking them about that kind of thing. I think it's not hard to gather that information. It just takes a little bit of research.
Yeah, I mean, look, I just put it into some to Grok here on XAI. Basically, it's around just shy of $50,000 a year for a Smoothie King in rent per year. So
Yeah, that's what I mean. It's like it's so and if your broker doesn't know, great. You can always fact check your broker. I mean, the point is like get a second opinion or a third opinion, right?
yeah,
We've got a lot of tools at our fingertips. So
so I think and I don't know, hopefully this is something that I guess I deal with a lot more than you do at this time, but hopefully I'm not confusing too much. I'm trying to keep it as abstractly basic as possible, I guess.
no, this
So
is. I mean, it's good. I'm trying to uh, you know, ask some questions, maybe highlight some of the things you're saying for, this is right up your alley here. And um, I'm trying to coax out of you some of those things that
yeah,
maybe any potential listener might have some questions about.
and so why? Let's go to the next big question. Why would
Yeah.
somebody want to develop versus and be the real estate investor? And because there's more risk in developing, you got to build stuff, you got to tear things
Yeah.
down, you got to like it takes a lot longer time. Like, what do you mean you don't collect rent until they open? I'm not going to open for 2 years, right? Or a year, like where real estate investing is. I'm going to go buy that building with a tenant in it, and I'm going to get a check in 30 days from that tenant, right?
Yeah.
So why on earth would you ever say, I'm going to wait a year and a half or 2 years to even get the first check? And then in the meantime, I'm going to go spend millions of dollars at risk for the potential to get that first check. So like, why in the hell would you even go this route?
Yeah.
Um, well, the main reason is the potential for, let's call it outsized returns, right? So if you're investing and buying something existing, you're really working off a pretty small margin um, on the return potential. If you go build something, then you have an opportunity to compound that return. As
Well,
in, hey, I may make 2 to 4% spread net profit ROI on this deal if I buy something existing. Whereas if I go develop something, I might see a 40 plus return, right?
mhm.
25% plus return on investment. Something that's
Okay.
like, how did you make that much money? Right. It's like,
Well, I think to the very first point that you made when we started this episode is that what you're doing as the developer is creating that
yeah,
margin, right? You're creating value where it didn't exist before. Like
that's right.
what you just said was like you could go buy a building that's already in place with a tenant that's already in place, but there's not a lot of risk there. The value is implicit and it's there, it's known. Um, Whereas here, as the developer, what you're doing is some of the risk is that you're creating that value
Hmm.
for someone else, and so you're there's value being born out of nothing or additional value being added, and that is that margin, the extra margin that we're talking about here.
Yeah, no, that's right. I mean, there's also a great deal of risk associated with it, right? We could have discovered a bunch of turtles that you can't move on a piece of dirt, or there's somebody
That's
stored a bunch of chemicals that you weren't, and it's, you have unknown expenses that can then dramatically impact that end return. Um, and believe me, you deal with it all the time, right? It's every deal has some kind of crazy wild thing that you didn't expect. So then you start to kind of budget that in and plan for it. But um so but that is the as you said it, the main difference between a real estate investor and a developer. There's a lot of real estate investors. Developing is it's a skill and a profession just like any other profession that you need to get really good at, years of experience, and have a good team around you, and do a lot of it's a lot of hard work. And but you do have the opportunity to make a bit of money, right? And then you realize that, the brokers end up making a lot of money too, and you get really mad at them. It's anyway, it's a different topic. But look, I'm not going to pull it up on the screen, but like right now, I'll just kind of take a look at what our average ROI is. Let's see. So, oh, let's see here.
Yeah, maybe that's maybe a good thing that you could talk about is like what does that margin look like? I mean, if you've invested the blood, sweat, and tears as the developer to create that value, what should you expect back?
So, I mean, we have a couple of deals that fall in the teens, right?
Hmm.
Um, which that's low, at least in my book. Um, for some reason, the system is pausing on refreshing, but there's a handful of deals where the ROI is 13, 14, 15%, and it's like, it's not exciting. Now, I'm sure there's people listening like, what the hell, 14, 15%. It's like,
Well, yeah, I mean, look, I'm at home,
sign
I'm
me up
listening
for
to this
that.
podcast, and I'm like, I'm learning about what I should include in my budget and how I should go do the research to figure out what my tenant can pay.
Yeah, we'll do a
You
whole
know, and
budget
I'm thinking like,
episode.
what should I expect? What should I expect to see? What makes sense for me as an aspiring developer? What should I expect the number to spit out at the end? What should I expect
Yeah.
the value? What should the value be that I've created? Where should that fall out?
Yeah, I would like on an investment, real estate investor side, pre-debt payment, like
Hmm.
assume you pay cash,
Yep.
I would be targeting anywhere from, I would say, 6.5 on a low end and 10% on a high end. So that eight, again, it's that 8% kind of area, eight and a half.
Yep.
Um, that's pre-debt, right? So that is
Right.
ignoring debt. On a developer side, I like to see things north of 20%.
Hmm.
Um, obviously we do deals south of 20%. Pretty much every deal is north of 10, right? It's like the lowest deal right now we got is 14%. And we probably won't do that deal. I'll find a different tenant and get that over 25%. Um, you know, outside of that, the next lowest deal is 23%. So we're consistently hitting 20. Our average right now, and I've got this is a new sheet, right? So I go ahead and back test and backfill, and it'll readjust the numbers. But just based on the deals I've plugged in so far, which are our current deals working on, it's we're in the 40s, 40+% ROI, which is good. I'm not gonna. That's really good. So,
Yeah.
but I think if I can break the 22 mark, right? Like if I can get 22%, 23% ROI, then I feel pretty good. I mean, like again, knowing that like there's gonna be some crazy things that happen, it's gonna knock some points off that likely, and maybe
Yeah,
settle
so there's
down in
some
the
margin
20.
for error in there, and we don't want
Yeah.
to sound like, I mean, this is not highway robbery by any means. We've typically spent a lot of time, a lot of money, and borne the burden of a lot of risk along the way to earn that kind of margin, right?
Well, and look,
I don't
those,
want people to get misled here.
and I do want to be very clear what those that kind of ROI expectation is at an exit of the investment,
Okay,
meaning
thank you.
we have sold it, right?
Hmm.
We're cashing out of our investment.
Yeah.
If we don't cash out, then the spread, again, going back to the spreads, be very similar to a real estate investor, right? You're going to be
Yep.
looking at, you know, the annualized kind of cap rate being back in that 8, 8.5, 9. So it's be very similar. Um,
So
but we,
maybe you could talk about a term that you just used there, cashing out. So what does that mean? What does that look like? You've talked about the early onset modeling of the deal. You've talked about identifying, what a potential tenant might be able to pay so that you can set up, um, a good pro forma with all your expenses and carries and all the inputs to get you to that point. Now you're talking about margins, which is what you're, modeling into the deal as well. But you've brought up this new term, which is cashing out or exiting the deal. Could you tell listeners maybe what that means and what does that look like? How does it, when does that even occur?
so typically we'll go into a deal knowing that we want to exit the deal quick. It's not
Hmm.
like some tenants you want to build and hold is like you see the value in like just holding on to the asset for multiple reasons, right? It's in a location that was so hard to get real estate in to begin with. Why give it up, right? Because it's always gonna be good. Um, the exit is it's kind of weird because like on an individual concept, it's like only sell real estate if you have to sell real estate, right? Um, but when you run a real estate development business and you have bills and salaries and people to deal with, and it's like you've got to create revenue source that's more than just sit and hold and kind of collect pennies.
It's got
And
to be a little bit shorter term, not longer
yeah,
term revenue.
exactly.
Yeah.
You got to have short term. And so we had different people we develop for or do land lease deals for that we know we're exiting the deal before we even buy the property, right? So we project in what is likely going to be the sale cap rate of a deal that we develop. So what that means is if I know I can develop a property and my year one cap rate is 10%, and I know I can turn around and sell that once it's open and operating, I can sell it. This is where that real estate investor comes back in. Real estate investor just wants to buy the thing already in place. They don't want to take the risk
Hmm.
of building.
Yep.
And it's like, all right, I started this investment. I'm able to get 10%. You, Mr. Investor, you're looking for 6% or 6.5% return on your money. And I know that, the type of project I've done right now across the country is trading at around a 6.5%, meaning I can go sell it to somebody. It's almost like the law of supply and demand, right? It's like
Yep.
there's certain businesses will sell at different cap rates based on that type of business. Now, in the world of the exit, like where I'm selling something, ideally, if you're sitting on something, you want to build it and sit for as high cap rate as possible. That means your return on your money is big, 10% big, right? When you sell it, you want to sell it for as low of a cap rate as possible, meaning that the guy coming in to buy it, right? You're saying, look, I'm taking the spread between these two cap rates as my exit profit. So, in the case of easy math, I built something for $1 million and the rent that's being paid on it, I'm realizing a 10% cap rate, right? 10% return on that invested money. I found a buyer who wants to buy it, and they'll buy it for a 5 cap, right? I don't know why they would, but they 5% return on money. That's a great deal. I'm only getting 2% in the bank, right? I'm
Yeah.
more than doubling my return on sitting cash, and they buy it for a 5 cap. So half of the one I've got. So basically, when I sell it, I think it's like I'm doubling my money, right? So if let's see, what would get me? Let's do this. Yeah. So all right, pull my calculator up. So $1 million building, it's $100,000 a year at 10%. So obviously $100,000 a year at 5% would be $2 million, right? So then if I have a thing that I built that's paying me 10% and I sold it to somebody else that then is going to pay them 5%, that means they bought it for $2 million and I walk out the door with $1 million, excluding all any kind of debt,
Yeah,
taxes, that kind
fees.
of stuff.
Yeah.
But in concept, you doubled your money. Now, most deals, you'll probably be able to squeeze 1 to 2% on that spread. You wouldn't see like a 5%,
Yeah, you wouldn't see 10 to
Now,
5.
we'll hear a lot of people say is like the use of basis points, right? 100 basis points is a 1%. So when you see people try to act really smart, they're going to say, "Oh, I've got 200 basis points. It's 2%," right? um, so, but I think what to expect is more of the terms of like a 2% spread or 200 basis point difference. So on that same deal, $1 million, $100,000 a year rent, which is at 10%, $1 million asset. Let's take off 200 basis points and somebody buys it for an 8 cap. That would be $1.25 million. So then the walk away is $250,000, right? So that's when I say the ROI that we're seeing is in the 40s. That is specifically related to projected exits on deals that we know we're going to sell. So um, that's the difference. So I think we've probably gone at least far enough for today's episode, about an hour.
Yeah.
There's a lot. Again, I mean, that was like the simple kind of dumbest way I think I can explain those things.
No, I think that was a good, thorough explanation. I was trying to lure you into the discussion of exiting as a way of exiting this podcast. So that worked out.
Do I get $1 million check when I turn this thing off?
Yeah,
Um,
yeah.
yeah, go then, and this is where like even on the exit, right? Then you're faced with, let's say you're just some guy who just developed something. You're like, oh, great, I'm gonna make $1 million, and you're like, oh shit, I'm gonna get taxed. That gets that, so now it's knocked down, you know, almost 30% or 17%, depending on what state and how long you held the investment on. So you're getting hit with the taxes on it. Let's just say 20%. So now you're down $200,000. And then, you got to pay your real estate broker who sold it, um, their commission, which that's a whole different argument in itself. And, I'll tell you where the heartburn comes from. And it's when say you're a developer and then you risk, say it's your first time doing something, but you're really smart and you did all your homework, you did it right, and you made money. And even at that point, it's to spend years doing something. Like you spend all this time, just endless hours, unmeasurable time going in to find a deal, piece it together, go through the pain of getting investors and banks involved. You convince them that what you want to do is right. You do it. You hire the architects, the engineers. You go through the pains of development. You pay their fees, go to permitting, beating your head against the wall with permit office. Then you get just for the privilege of getting a contractor who doesn't do what you need them to do to then have to fix like the the sheer pain and risk and frustration that that you go through to get to one day a point in time where you start getting a rent check and then you can say, now I can go sell this thing that I just spent way too much time on and all my money on and years to get there. And you say you walk away with an 8% return or 10% return. And you're like, I made some good money. And then all of a sudden this bill comes in from the real estate broker who already had the buyer. And he's like, you owe me 6% of the sale value. And you look at
Yeah.
like after you pay your tax, all this, you look at what they made, you're like, well, shit, like they made almost as much money as I did. And they just sold it. Like now, to their credit, there's probably years of establishing the network of buyers and maintaining that kind of thing, and they have their own expenses and taxes, and so it's not as simple as I just made it. It's like they're just stealing the money. There is value with it, but there's you start to think a lot about um kind of like these societal constructs of like why people make more money than other people in different businesses and things, and it's like sometimes it's just not fair at the end of the day. But it's um, so it's why is an attorney's time worth 400 or 500 an hour when, you know, say we sell our time for a couple $100 an hour and they can write all the legal work better than they can write it, but they still got to be the one to do it and then charge you more. It's just like, especially in today's technological world of what's available to like automate and expedite certain tasks and skills. I think a lot of these things are going to get broken down and have to get reformed at some degree um, when all this technology starts to kind of fold in, which will probably be for the best, right? It's definitely going to screw over a lot of people, but people will figure it out. Um, but anyway, I don't want to go down like a diatribe of complaining against real estate
Yeah, look,
brokers.
let's have a
It's-
broker on before we
yeah, yeah, no, it's I would love to have a broker on. Be like, so all right, I want to sell this. So what exactly are you going to
let's
do,
have
and
them
how much are
talk
you going to charge
about
me for this?
yeah, let's have a broker come on and talk about the value that they provide um before we get into that subject matter.
So I don't know. Maybe it'll coax somebody to listen and
That
like
that would be to
comment.
use a term that you coined fair, is to give them an opportunity to defend that value.
Yeah. All right.
Well, cool. Thanks for sharing all that today, Chris. I know this is something you know a lot about. It's sort of what I would consider to be like, I mean, we barely scratched the surface of it today, but I would consider the subject matter to be like your, I don't know, area of expertise, but probably also passion too. I mean, I know this is something you're really interested in. I'm interested in it. I just don't know it as well as you do. So I kind of just shut up and let you talk mostly and just ask questions that our listeners might want to ask.
Well, I
So
wouldn't even call myself an expert at it. I just, it's
no, but in fairness, I would call you an expert. I mean, I think this is something that you've spent a lot of time across your career developing and understanding, and so yeah, I would consider you an expert in it.
I think kind of going back to our beginnings, right, as architects, at some point, my career, which then you kind of folded into this as well, doing like the bulk of the development activity. Like when I talk about like just as described, you go through years of the risk of hiring architects and engineers and managing contractors and permitting offices, like the things that are really going to screw you at the end of the day if you don't do right um, we as architects, specifically in our experience, moved over into more like this program management of development, where we were managing 90% of the risks, right, associated with the development,
With no
and
reward at the end.
with very little reward.
Yeah.
And so the it didn't take me long to be like, well, hold on, like all I got to do is figure out the money side of this, and yeah, there's skill there, experience there, there's risk there as well. But what really bites a deal in the ass is when you pencil something out on a pro forma to make it mathematically work at the beginning, but have no idea how to execute through to the end of the project to make sure that your mathematical projections at the beginning are held up throughout and equal at the end. Um, so we came from like a very interesting, I guess, perspective, knowing how to manage the middle, right? Because we knew how to manage the thing that's going to completely derail the back end of an investment, and we knew that how to manage that the best. Like that is what we did.
Yeah.
So then to
We
then go at
minimize
the
the risk.
front, yeah. So then to go to the front of the deal and say, oh, let me just learn how to do all the math and then like do the projections. Well, now we do the projections knowing that we have all the knowledge and experience of the middle of like the things that it's going to screw up the
The
projections.
control.
So
Yeah. Yeah.
it's it's I think it's afforded us quite a deal of advantage, instead of just being some like real estate investment analyst at a desk, like, oh, I think concrete cost whatever dollars, and yeah, of course they're all going to show up on time and not drag this project out for months and months, and you know, it's, but anyway, the like I said, we will definitely do a lot more diving into this. I mean, we could probably have 200 episodes just on this topic alone. I'm hoping, I guess like you're mentioning, like I've got my little spreadsheets and templates and kind of things that we built over time, and we're always adjusting them. I think one goal I have is to try to figure out how do I make kind of, I wouldn't say a catch-all version, but um, at least something that gets somebody within a range of acceptability of like a template to like do some development projections, um, with some weights in it. Like we know, like we already know, like if a property is not zoned for what it's worth, you add 5 months, 5 months of carry. If you can't delay your closing, that has a value add, not a value, an expense add to the deal that needs to be factored into the pro forma. So like we know, like a simple yes or no, is the property properly zoned for the use? If no, right, it weights it with a variable that then adds dollars and time to the whole pro forma. Like that's the kind of like nuanced thing, is that if it was built into a template, maybe somebody doesn't have to know all that experience. They just kind of trust that the formula is working.
Right.
I would like to get to the point where I have something like that. That would be useful for like listeners or people, right? Um, anyway,
Yeah.
all right. Um, I think the Brazil qualifying starts, or I think, is it qualifying today or
So,
sprint? It's
is it today? So, is it on right now?
it might be. I think it might be starting right now. It's not the race. I think it might be the sprint. Um, but anyway, we'll take a look.
Where are you going? Colonel's Club to catch the sprint?
Yeah, yeah. I'm gonna go. But you meet me there.
Yeah, maybe we should look. Hey, sounds like a great place to host the pod one time. Maybe we can even get a sponsorship, Jordan, if you're listening.
Sponsorship, meaning AKA free cocktail
Yeah.
while we talk.
Hey, look, it
So,
doesn't take much.
yeah. All right. I'm gonna shut us down. See ya.
Sounds good. See ya.